Hey, everybody, this is Charles Dobbins. Welcome back to this week's edition of the Multifamily Investing Academy's podcast with me, your host, Charles Dobbins, the multifamily attorney, the founder of the Multifamily Investing Academy, the creator of the Multifamily OS platform, and the co-host of the upcoming Hotels to Apartment Conversion Summit, one in Fort Lauderdale, one in Chicago. Check out my website. The tickets are on sale now. Get the early bird special. And it's just going to be an absolute jam-packed event. We're so looking forward to it and would love to have you here. And to this week, I have with me, and first off, Mitch, I'm going to say, before I give you the promo.
Okay.
We're gonna ask my brother, Lenny, who's my top, he's my number one audience member. He shows up to all my podcasts, okay? And I'm going to say, Lenny, I'm not going to tell you. You're going to have to text me. Where do you think, based upon his accent, our guest is from today? Okay, so we'll wait to see. So, Mitch, don't give it away. Don't give it away.
I wouldn't do that.
And my clients all have my text numbers. So let's see if they can text me and see if they can figure it out as well. So, but Mitch, you are a visionary entrepreneur who has revolutionized the commercial financing industry. You got over 30 years of experience in the mortgage banking and a track record of closing several $1 billion worth of loans. But the thing is, you similar to me, and this is where I think you and I are kind of on the same path here. You identified the need for a platform that empowered borrowers and simplify the whole entire loan process. This led you to create the company that you have right behind you, calmloan.com. That combines cutting-edge technology with exceptional customer service. And I can't wait to get into that with you. But one thing I have to talk to you about, because I'm looking at you, we're probably close in age. You had something down here about you built, after you left all the big firms, the Leventhal and Horwath and Arthur Young, you built a residential bank business that funded billions in loans in 5 Western states, and you exited lending after the 2008 economic collapse. How'd you survive?
Barely.
Exactly.
It was an interesting time, very humbling. I think everybody that I shared a story with, with hindsight, it's probably the best thing that happened to me, because it certainly humbled me. It changed me forever, and I believe for the best. Mm-hmm. But yeah, it was a very, very difficult time. I mean, we were at the eye of the storm. Obviously, a residential mortgage bank. We were in Arizona, California, Nevada, New Mexico, Texas. So we're in 3 of the 4 worst hit states: California, Nevada, and Arizona, where property values just plummeted. I mean, in some cases, 60%. So the strategic foreclosures were off the charts, where people just would hand back their keys because the house was worth a fraction of what they owed on it. And then, pretty much the agencies just started pushing back to whoever was left standing. And I was pretty naive. I thought I could fight it. I should have thrown in the towel along with all the big guys when Countrywide threw in the towel, and a lot of them. But I thought I had a cape and a sign on my chest, and I could beat this thing, and it beat me, man. It was it was brutal. And I think the one thing that it taught me was what I could withstand and what I could go through. And it was very, very difficult. Kept the company going through till about 2012, and then just the contingent risk and the problem was also there was no liquidity in the market. The only loans being funded really were the government insured FHA, VA. Fannie Freddie had pretty much dried up.
Right.
So it was just a very difficult time. I mean, there was no liquidity in the markets at all. So wound down the company. For a few days I felt sorry for myself, and then said, right, what's the next opportunity? And got exposed to commercial lending, and I guess ComLoan, and the rest of its history. So
exactly, here you are now.
Yeah, exactly.
Yeah.
So with hindsight, it was a blessing, but at the time, I certainly wouldn't have thought so.
Yeah, failure is the best teacher. You were on the western part of this country, and what I've heard is that it hit you guys before it hit the rest of us. I'm out here in the East. You're out in the West. They said that you guys were about 6 months ahead of us. Do you think that's accurate?
Yeah, I think to some extent, and the reason being is I think, obviously the underlying cause of the whole collapse was there was really no substance to the market, and the Western states really were the epicenter where it was such a speculative environment where people were just buying properties and flipping and buying and flipping. And I knew we were in trouble. I was at the gym the one day, and these young guys, I mean, they were really young and certainly sounded very inexperienced. And they were saying, yeah, I've just bought 5 homes and I'm, flipping this house and that home. I thought, oh my God, this isn't good. This is, and that's what it was. There was really no underpinning on the values that these homes were trading at. And yeah, when that first hedge fund collapsed, I think it was in August of 2008, and that was the beginning of the end. It was like a domino effect, but nobody anticipated it being as deep and as widespread, as it was. That it brought down massive insurance companies and banks around the world were affected. Anybody that's holding mortgage-backed securities. So yeah, it was a challenging time.
That example that you said of the young guys coming in and you're going like, oh my gosh, I liken that to the Joe Kennedy Sr. scenario when he was getting his shoes shined. Have you ever heard that story?
No, actually, I don't believe I have.
So Joe Kennedy was a very bright financier. He owned a bank in Boston, and he was, before the stock market crashed, he was getting his shoes shined. And the shoe shine boy knew more about the stock market than he did. He says, time to get out of the stock market when that's your Joe Kennedy moment.
Well, it's just, it's all the speculation. It's almost, it's like a gold rush and everybody's in, and you have people in it that really don't know what they're doing, and everything just gets so overheated and there's really no substance to it, and if there's in a particular area, if you have property and say, look at Phoenix and the Scottsdale area where I am now, and you look at it now, and there's been enormous appreciation in home values, but there's been incredible population growth. There's been enormous industry growth, with the Taiwanese semiconductor factory opening here, which is just massive. So there's real underpinning of the growth and of the increase in values. It's not just speculative that guys are buying and flipping. I mean, people are buying homes to live in there. Yeah. So, I think part of the challenge was back then, it was just so speculative. There was really no substance behind the rapid increase in values.
So I envision that on Friday afternoons when you have your office parties and you get the pizza, you're running an episode of The Big Short in the background. Your favorite movie, as it is mine.
Exactly. Yep. Exactly.
So what do you think about what's going on right now? Before we even get into your program, which I definitely want to get into, I want to get your feeling on what's going on now. Now, let me just, as this podcast is about to air, four properties were taken back by Arbor Financial down in Houston. I think for not necessarily, I mean, they were bad properties and the guy was a shady operator, but those got taken back. Arbor Financial, there's somebody that's, saying Arbor Financial's in financial trouble. We're hearing from some of our friends out in the marketplace that a lot of these sponsors are implementing cash calls for their properties right now, which is the first sign of the kiss of death. So, set up the scenario. What do you see going on right now?
Yeah, I think, and particularly obviously in the multifamily space, I think there was just enormous run up, and to some extent there was a little bit of that hysteria that the party could never end. So people were buying properties at ridiculous cap rates, particularly ones that were value add. And, so what happened, they would buy a particular property at an extremely low cap rate. It was a value add, but, they were buying and they were getting a bridge loan maybe back then in the 4s or, maybe maybe in the early fives or whatever it is, but we're expecting, an exit. They were working out their cash flow, that their permanent financing was going to come in at maybe, maybe they weren't going to get the mid threes as what it was then, but they were factoring maybe mid fours, and life was good. And the other thing they were factoring is these rental increases, that we're getting these nice year on year. So they were penciling out the deal with all these nice, so when the property stabilized, the higher rents, decent interest rate, life was good. And what clearly has happened is, interest rates are substantially higher than what they had forecasted, probably, a good 2% higher. And that, you haven't got that rental increase that they were planning on. So I think the properties that are in the most jeopardy, and the principles that are in the most jeopardy, are those value adds that the bridges are coming due, and the numbers just don't work. They're not going to get, based on the higher interest rate, they're not going to get the proceeds that they were expecting to pay off their existing bridge, because the property is just not penciling out at the higher interest rates, and with the rents not necessarily being what they thought it was going to be. And I think that's where a lot of the cash calls are going to come in. And I think that group of syndicated deals that were in value add mode, I think that's where we're going to see the biggest potential challenges. How big of a percentage that is of the overall market, I don't think it's a massive percentage.
Do you think it's going to be more regional?
I think it is going to some extent going to be regional, but I think it's more just that class. If you got a property and you got a permanent loan on it, and you're sitting on it in the threes, even if it's coming at refi, if it's coming due now, that means you bought it probably at least 5 years ago, if not 10 years ago. You've had enough run up in value that hopefully should be able to cushion any increase in interest rates. So you should still be in line on your LTV. Plus, you've had enough run up in your rentals that you really, in probability, shouldn't have problems. It's those short-term bridge guys that I see the biggest challenge at this point.
Are you hearing? Let me just kind of give you a picture here. I'm actually going to switch my screen. Are you hearing anything out there where this one happens to be what I've heard, one particular dust lender that owns its own REIT is marked down as like their stock is doing terribly, they're in big trouble, they're doing some moving money around to make their books look better. Are you seeing anything that from any dust lenders, from any other lenders out there? Do you think there's going to be more of a problem with the banks in the commercial space coming soon?
So there's a lot of statistics running around, and obviously after the Silicon Valley and Signature Bank failures, I think everywhere is like, oh my God, this is the beginning of regional and local banks collapsing, in mass. But I think I think a lot of the data being reported as to the extent that these regional and local banks are holding, I think there's some reports anywhere from 65 to 80% of commercial loans out there are held by regional and local banks, and that's inaccurate. I think Moody's put out a report that it's closer to about 13.8%. So, your big nationals obviously are holding a good chunk, and even if there has been some flight of deposits from the regional and local banks, which obviously are going to diminish their ability to lend more, where's that money gone? That's gone into the big national banks, because obviously everybody believes that's a safe harbor because they're too big to fail, and the Feds would never allow that. And the long and the short of it, the Feds have sort of stepped in, even with Silicon Valley and Signature Bank, that have sort of minimized the damage in those banks' collapses. So we're a marketplace. We've got probably 750 plus lenders on the platform, and there's still a lot of regional and local banks that are lending. I think clearly that the credit boxes have tightened up. They're reducing LTVs, maybe increasing their debt coverage ratios. The one huge thing that I think is across the board is everybody's requiring more reserves. Whether they put up, with some kind of a cash deposit up front as a liquidity reserve. I think that is the big common denominator we've seen across the board, be it with banks and even with agency. Everybody wants to ensure that, on any new loan that they're going into, that the borrower's got sufficient reserves and liquidity, and the banks, and in most cases, the banks holding those reserves as a cushion to weather any potential storms.
What kind of formulas are we seeing for these reserves? What are they requiring?
I think it's all over the place. It's not really necessary. It could be anywhere, from, a year's payment. I think it just, each one sort of has its own requirements. I think the banks are just looking at the overall strength of the deal, the LTV, the sponsor's strength. And I think besides the reserve, I think, the sponsor's liquidity is very important as well. Just how liquid are they and how strong they, what's their asset makeup? How quickly could they liquidate assets if they had to, type of thing. So, but I think there's a lot more scrutiny on liquidity at this point.
Okay. Now, before we talk about your program, you made the switch from residential to commercial. That was your big escape. Why'd you go to commercial? What's the advantage for you there?
I think twofold. I think it was more an opportunity that I saw. So I started dabbling in commercial, and I got involved in one or two deals, and I thought, how does anybody know where to go? Unlike, residential is very homogeneous. You've got, from a property type point of view, you've got single family homes, and you have 1 to 4 units, and you have maybe condos, and that's your property makeup, right? And then as far as programs go, you generally have a 30-year fixed, a 15-year fixed, and you maybe have a few intermediaries. But that's it. And from a lending point of view, it's dominated by the agency lenders. Fannie and Freddie make up a massive percentage of the conventional financing, and then you got FHA, VA, and a small amount of portfolio type balance sheet loans on the jumbo stuff. But so really, it's very homogeneous from a property type point of view, as well as from a product point of view. Commercial lending is the antithesis of that. You've got all your different property types. You've got retail, office, industrial, multifamily, which we call the 4 main food groups, right? But then you got everything else. You got hospitality, you got single purpose, car washes, self-storage. And even within that, you got all your subcategories. So for example, hospitality, you got full service, limited service, flagged, unflagged, open corridor. And every lender's got a different appetite for a particular different property class or even subcategory. And then you got all these different kinds of lenders. On the multifamily, you got agency, but then you got CMBS, you got banks, and then all banks aren't created equal. You got federally chartered, state chartered, community banks, credit unions, then you've got life companies and debt funds and private money. Everybody plays according to their own rules. There's no standardized in sizing up any deals. Everybody will come in and out of the market depending on their own needs. So for any commercial real estate borrower, how do you know where to go? How do you know you're getting the best deal? So when I first got into it, I went online. I said, there's got to be some kind of a search engine that I can go and I'll key in the parameters at what I'm looking for, and up will come the lenders that best fits my needs. And if you look at our economy and our environment, that's happened virtually across the board. With Amazon on retail, and then you got Expedia and Priceline and those guys on travel, and so every aspect of our lives is really being dominated now by huge access, essentially giving you access to a marketplace and a really robust search engine, which will help you navigate that marketplace. So I thought this had to be it. It was logical based on the complexity and the diverse nature of the commercial lending industry that existed for commercial. To my surprise, it didn't. So the next logical thought would be, well, if it doesn't exist, maybe it can't be done. Well, that's probably not the right thing to say to me, because I figure, well, there's always got to be a way. So I went and I interviewed a whole bunch of different lenders, from SBA through banks, through credit unions, through Fannie Freddie, through CMBS lenders. And I said, how do you guys size up a loan? What do you look at? So it came apparent that every lender has a particular lending footprint. This is where I lend, right? So you can define it. So that's a search variable. Then everyone says, well, I got a minimum and maximum loan amount that I'll do. Another search variable. I'll lend on a particular type of property. That's a search variable. And then you get into your algorithms like debt coverage and debt yield and global debt, but those are just mathematical calculations, right? As long as you got NOI and your payments, etc. Then is it recourse or non-recourse? What is your prepayment penalty? Time to close. If it's recourse, you look at your sponsor and you say, what is their credit score? What is their nationality? Because lenders will look at sponsors differently if they're not US citizens. And then, have they declared bankruptcy, not declared bankruptcy, what is their net worth, their liquidity, etc. So there's probably about 20 plus key variables that are common to any lender, irrespective of the type of lender, how they size up a deal as whether they want to see that deal or not. And I said, well, this is ripe for a search engine. And if we capture those variables from a lender, and then we capture the variables from the borrower, we should be able to match the two and create an environment where, for the first time, we're giving the commercial multifamily borrower access to the marketplace. So I'm not a tech guy, obviously came from a financial banking background, but I was very fortunate to hook up with who is now our CTO and has been for the last several years. We locked ourselves up in a conference room. I said, this is what I want to build. Can we build it? He says, sure, we can. And about a year later, we pressed the button and it worked, which was fantastic. So just feel very blessed. We currently have in excess of 750 lenders on the platform.
Okay, so hold on. I love the story you just gave. I got to bring it down to the street level for everybody. So what Calm Loan does is it's all online. Like, for instance, I just went online. I chose the drop-down option, multifamily, chose the LTV, chose the loan amount, and then, hit enter. Then obviously, I fill in the information about who I am and so you can get in touch with me and submit a request. Now, when I submit a request on multifamily, what comes back from you guys?
So you got a fun little tool on the website, which sort of just tells you how many lenders are available and the best possible rate. But what happens, we recognize that we're dealing with a very technical product, right? We this isn't like going and buying a TV from Amazon. It's a big dollar amount, it's several $1 million that are involved. And there's a lot of moving parts. There's a lot of variables that a borrower could be looking at. What's important to you? Is it payment? Is it interest rate? Is it maximum proceeds? Is it non-recourse? Is it your prepay? So every borrower's got to, ranks their priorities on the variables that are most important to them. So we recognize by recognizing that this is a technical product, we actually match the borrower with a very seasoned originator to almost mirror that effect that if they were sitting down with their favorite banker or lender. So what would happen? They go in, they fill in their basic information. Within a couple hours, they get a phone call from a loan consultant who'll say, all right, share with me, I've got your information. What are you looking to achieve? What are your hot buttons? What's important to you, Mr. or Mrs. Borrower? And then we prioritize those variables. Okay, so your first and most important variable, you want maximum proceeds, check. What's next from that? All right, I want lowest payment. Lowest payment isn't necessarily the same as lowest interest rate, because it could be stretching out your amortization to give you a lower payment, maybe at a slightly higher interest rate. So lowest payment is next. What's your third? Lowest interest rate. Okay, what's next? So we prioritize what their requirements are. Our loan consultant will then run it through our system while the borrower's on the phone and generate the results. And the results could be coming up with 50 results, in many cases a couple hundred results. We then filter it based on the borrower's key requirements. At that point in time, once we've narrowed down generally around the top 6 lenders that perfectly fit that borrower's need, we hit a button, the borrower gets an email, they set up their password, they go into a portal, and they get a download of the 6 best results that fit for them. If they decide that that does work for them, they would sign a very short exclusive agreement with us. And there's 2 reasons why we have an exclusive. The first reason is obviously we're going to be packaging that file and managing the transaction all the way to closing with the borrower and the lender. So we're putting a lot of man hours into it. The second reason is we have found that if a bank sees a deal or any lender sees a deal from more than one lender, or from more than one broker, they're not going to take that deal seriously.
Right.
Things being shopped around the world, nobody's controlling this deal. And generally they don't put their best foot forward. They're sort of going to throw something against the wall and hope that it sticks. Every lender on the Com Loan platform knows we control the deal. They really sharpen their pencil because they know there's a very high probability of them winning the deal if they want to win the deal. So those are the 2 reasons. The borrower would sign the basic agreement with us. They would then get introduced by our transaction management team, which will then really package the loan and interact with the borrower and the lenders all the way through closing. So the transaction management team would send them their needs list, which would come through the borrower portal. They could upload all their documentation through the borrower portal. We package the loan. Our packages, if I say so myself, are outstanding, very consistent, very detailed. So the lenders love it. I don't know if you're aware of a statistic, but 2/3 of all commercial real estate loans funded by lenders are originated by third parties. So the majority of loans that virtually every lender gets is coming from somebody else. And the quality will vary dramatically from your very professional, seasoned brokerage houses through to your mom and pop where they just throw something against the wall and hope that it sticks. So we recognize that it's really important to provide a value to the lender as well. We're not only providing a better value to the borrower, but to the lenders. So the lenders are getting loans. When they get a loan from Com Loan, they know it's been pre-sized up according to their sizing up variables. They're going to want to see the loan. They know they're not going to get something that they don't want to see. And it's very well structured, very well organized. They get the T12, the rent rolls, the financials, whatever they need in their sizing up requirements. The lender gets a portal as well. So the borrower works through a portal, the lender works through a portal, the lender quotes the loan through their portal. So everything now happens in a self-contained ecosystem within our platform. 2 reasons: just ultra smooth, quick communication, but also from a security point of view, you're not emailing sensitive data like tax returns or personal financials. Everything stays within the self-contained, secure ecosystem. So what our mission is not only to provide better access to the consumer and to the commercial borrower, but really a much quicker, better experience. So we're very, very focused on the borrower experience. I will interview as many borrowers as possible after we close a deal and say, how did it go? What could we do differently? So we live in the mortgage broker or the commercial mortgage broker space, but essentially we're a tech company that's really going to redefine, and we are redefining that borrower and lender experience and that interaction between the two.
Gotcha. You said something that I learned early on when I went into the commercial multifamily space, and which was entirely different than residential, which is that if you blast your offer, your application out to 10 different brokers, you are not taken seriously. Like
No.
you need to find one source and let them broker the deal to go to the right sources.
Absolutely, because then the lenders take them seriously, particularly and if they've got a good reputation with the lenders.
Yeah.
So, when as I said, the lenders know when they get a loan from ComLoan, we control the deal. It's been well structured. We packaged it. We've run the spreads. We've done all the things that we believe they would do. So we make all the necessary adjustments for vacancy factors and, does the management fee look in line? The insurance number, obviously insurance is a big issue now with multifamily. Yeah. Particularly regionally in certain states. Florida particularly has been pretty badly hit with insurance increases. Yeah. So we will go ahead and do all that initial heavy lifting for a lender to really make it easy for them. Our objective is when that individual working with that loan officer or whatever at any particular lender gets our deal and gets that ping in their email, like you have mail, you've got a loan. They go into their portal and they know it's going to be within no time. They've got enough information and it's well enough structured that they literally could put that in front of their loan committee to get a term sheet. That's great. And to get a meaningful term sheet because they've already seen all the spreads, everything's run. We've given the write-up, we've given the narrative. So they get, it's got photos of the property, it's got all the demographics on the area, and it's a very, very detailed package.
Okay, so are you a DUS lender unto yourself, or do you work with other DUS lenders?
We work with other DUS lenders.
So is there one in particular that you like, or do you see some of them being different? I know as a consumer of DUS products, there are some that I wish I had never done business with, and there are some that are absolutely your partner in the deal. How do you operate when you have I think last time I heard there were 26 DUS lenders out there for Fannie Mae paper. How do you feel about working with anyone over the other?
So we have probably, I think about 8 or so of those 22 that are on our platform. Okay. And it generally is of the 8 more prominent, better ones. And they're all going to vary. It's quite amazing. They all have different appetites for different deals, based on locality, on region. And they're all going to look at a deal slightly differently, even though they're all, ultimately selling the loans off to the agency. They've got different experiences as far as their servicing portfolio, and as a result are going to run the numbers slightly differently and make certain adjustments differently. So I think there is the advantage of the loan going out to a few of the top agency lenders, and we won't register it with either one until we're ready to pull the trigger. So it's a case of really having your cake and eating it, of saying, all right, who's going to size this up the most favorably? And the most important thing is who's going to focus on what's important to the borrower. Once again, it comes back to empowering the borrower. Up till now, the golden rule has lived very much in commercial real estate lending. He who has the gold makes the rules, right? And up till now, the lenders had the gold, the money, and they've made the rules. And what we're really doing is we're turning that golden rule on the head, because money is a commodity. It's, whether the money's coming from bank ABC or agency lender ABC, it really doesn't. It's the same money, right? It's a dollar's a dollar's a dollar. So what it really comes down to is what's important to that borrower. And instead of trying to shoehorn the borrower into the deal that the lender's got, let's rather define what is it that's important to the borrower. What are those key variables? And every borrower is going to have different variables. For one borrower, a prepay is a huge thing. I don't want a prepay, or I want a minimal prepay. Then maybe agency at that point isn't really going to be the best option for them. and possibly we can get a bank or credit union deal with no prepay or minimal prepay. And yeah, they don't mind recourse. So, or limited recourse or whatever. But what's critical is, what does that borrower want? What is their hot buttons? And let's fit them into a program that ultimately best fits that borrower's needs, opposed to, all right, well, we're going to go to agency and let's hope we can fit it, or we're going to go to a bank and let's hope we're going to. No, it's really not every borrower is created equal, and conversely, not every lender is created equal.
All right, last question. You talk about your program and your system and what have you. I've done the same thing for my business and my clients. We actually hired a development company, a development team, spent a lot of money in creating a customary program for my customers. It sounds like you did a similar thing. You actually hired the developer and he worked for you, and it took you a year to put the whole thing together. How'd you like that experience, Mitch?
It was fascinating. It was really great. I mean, ComLoan consisted of me at that stage. I was the sole employee, and I would get up in the morning with my shorts and sandals. It was great, and
because you're in Phoenix.
Yeah, into a little executive suite, and I'd design for the day, and then I'd send it off to the development team. And our development team, we still have an office in India. We have a full-time development team in India. We got an office just outside Delhi. And I would send it to the guys and they would develop at night. And then next morning I would test. And at night I'd have meetings with them. My schedule was a little wacky. I'd get to bed probably at midnight, because 10 o'clock at night here, which is in the morning there, I would have my call with them, and, get into bed at midnight and your brain's racing. But it was a phenomenal experience. It was fantastic. And we still have a full team. We're constantly doing enhancements, and the platform as it is today to what it was back then is totally different.
Yeah.
But it's just been a phenomenal experience, and it's a great journey. I mean, it's a great ride. Up till now, all our loans have been, consumer direct and from referral partner relationships, where we have certain commercial real estate companies and actually residential mortgage banks that are referring us commercial deals. We just, the end of this month, going to be launching a program where we're going to be bringing on traditional commercial loan originators onto our platform as well, to enable them to use it. So it's been a great ride. Really excited about the future. It's almost counterintuitive what's happening to us. The sky's falling in, the economy and things are slowing down, and we're probably busier than we've ever been, people are shopping online. We're getting unbelievable sponsors, people that have several $100 million or $1 billion portfolios that have had these deep relationships, and now they go to their lender, and either the pricing is just off the charts, or the lender say, we just stopped lending on this property class. Yeah. And that's another thing. Everybody says commercial is relationship. The relationship's one-sided. You know what I mean? When the lender decides that they're not going to lend to you, you could have been working with them for 20 years. They're not going to lend to you. Yeah. That's the bottom line. So I think what it comes down to, is just really finding the product that best fits your needs at a particular time, and we're just a great vehicle to give you that.
That's really interesting you say that. I have always said that, like a real estate broker, it's all about relationships. Typically, it's one deal long. The relationship is one deal long. And, just like you said, if the guy can't do it for you, you got to go start a relationship somewhere else. So, it's a relationship as long as it's one deal long. And
exactly.
Yeah, you're absolutely.
And with us, because we call it like lender agnostic. We really don't. We could care who the lender is. You could have a long-term relationship with us because we're the marketplace. Sometimes I'll have somebody come to me and say, "Well, what is your this rate? What is your rate on multifamily?" Well, okay, how about giving me a little bit more? Is it small balance? Are you looking 5-year? Are you looking for a 10-year? Yeah. What's pretty cool, and I'd be more than happy to share it with you, we could give you a link. We publish our average rates by property type. So we have commercial, we got multifamily, and then we have, for example, we have for multifamily, we've got bank, agency, small balance, CMBS, and we give the 5, 7, 10 year. And that's published daily. That's live pricing, because our database is kept current throughout the day. We've written algorithms which mirror really how the Fannie Freddie lenders will price their loans, the same with CMBS. And then on a lot of the banks, their pricing is just an index plus a margin. So we capture what the margin is, and obviously we link to that index.
Right.
So it's a very cool tool, and I'd be happy to make that available to you, that you can put it on.
Well, go ahead and just say it out loud here, the link for that, so that we can, and then we'll put it in the show notes as well.
So all that, I mean, the easiest way for any borrower to get there is you go to comloan.com, and then you just click on the little menu button on the side and click on mortgage rates. And there it is. It'll be live, a page of mortgage rates that are kept current on a daily basis.
It's the second option on the drop-down menu, mortgage rates.
Yeah.
And, boom, you're there, right there. It's perfect. Good.
And that's an aggregate of, so it's a really, really great representation of where the market is.
Gotcha. All right. So Mitch, just so that we'll give my brother a little bit of a hint. I will ask you in one sales pitch line in your native tongue, give us the pitch on ComLoan. And just for the record, and I hope I'm going to state this correctly, even though his last name is Ginsberg, it's not an Israeli accent. It kind of threw me there, but go ahead, Mitch.
So you'd like me to speak in the language that's spoken in that particular country, right?
Yes.
Okay, and give a pitch of ComLoan. Wow, okay.
Yes.
I've spoken there for a while. Okay, so mijn naam is Mitch Ginsberg. Ik werk bij ComLoan. ComLoan is geen geld voor mensen wat wou geld krijgen om iets te kopen, bouwen. Misschien huis of iets te koop. En ons het baie. Oh my God, I haven't.
Mitch, he's not going to have a clue. He's not going to have a clue.
Getting into the technical terms in Afrikaans. So I guess I've given.
Oh, Josh, no, I have to bleep you. Hey, Mitch, thanks for coming on the show. It's great to meet you.
Thanks a million. Great to be on the show, and look forward to chatting future.
That'll be great. Thanks so much.
Take care, man.
Bye-bye.